Yeah, market news now. Well, Wall Street's fear gauge, also known as the volatility index or the VIX, hit its highest in almost 5 months on the back of a pullback in interest rate cut expectations, as well as the escalating geopolitical tensions. As we know, the VIX is an options-based measure of investor expectations for near-term stock market gyrations. It hit 21.3 points, crossing the psychological mark of around 20 points for the first time since October last year. However, next week's earnings reports from some of their biggest technology and growth companies could prove an important test, especially when we're talking about the US stock market rally. So we are expecting to hear from the likes of Tesla, Meta Platforms, Alphabet, as well as Microsoft. And these companies are part of a group of companies that have been dubbed the Magnificent Seven. And we've seen them lead the S&P 500 last year by up 24%. And this was the gain that we saw. So again, investors are going to be paying attention to a lot of these companies to see whether the valuations here actually catch up with earnings. However, to help us look back at the week that was, and perhaps even throw forward to next week, we are joined by Skulk Low, who is a wealth manager at PSG. Skulk, thank you so much for your time. So much has happened over the past few hours. We've had oil price tick up, we've had gold prices tick up. What do you make of market sentiment, and is the worst over?
Oh boy, what a question. Let's first go check my crystal ball. But yeah, how does the saying go? It's the morning after the night before. And I don't know if I want to, just look at the night before, because this week, we went into this week, having Iran attacking Israel. I thought Monday, we're going to have a very, very difficult market. Things seem to be quieting down. And yeah, we're sitting on Friday, going into the next weekend. And yeah, we saw what happened last night. Israel retaliating, sending some rockets through Damascus, to Iran. And I think we don't know what's happening. We went into this morning, oil price 3% up, gold price, touching close to that $2,400 levels again. But you can see the market is nervous. You mentioned it, the VIX, trading at very high levels. There's a very nice indicator. They call it the CNN, fear and greed indicator. That went from being in an extreme greed, I think about 2 weeks ago, now suddenly in a fearful scenario. But yeah, I think it's going to be a very, very interesting weekend. I hope there's no retaliation. I hope this quiet down. But unfortunately, the geopolitical environment we find ourselves in currently, I won't be too hopeful.
Okay, so let's talk about something that could be a little bit more hopeful, US earnings. How high is the bar for the numbers that we're expecting going into next week and onwards?
Oh, it's high. It is really high. I mean, when we look at the 25-year, average, and I look at the forward P because that's the expectations. When you look at 25 years, forward P, we're trading currently closer to a 21 times, forward P, average run about the 16 times level. So it's high. It's at least one standard deviation higher than the mean, which means that there's definitely some great expectations. And thus far, it looked good. I mean, you mentioned the Magnificent Seven. We had Netflix already reporting today, and Netflix beat, and it looked really, really good. Share price not reacting currently, maybe a little bit fearful with everything happening in the Middle East. Share price current indication is going to be down. But as it stands, I would say 5% of the companies already reported in the S&P 500, and currently 86% of them beat expectations from an earnings point of view. But the interesting one is the revenue only a 50-50 scenario. So I think it's going to be quite an interesting one. Thus far, the companies that did report, I think the general trend is we've done well, beat expectation in the first quarter, but the latter part of this year is not going to be that easy. Interesting.
Let's talk about the Fed but have you thought about the scenarios, like what happens if the Fed can't cut rates in June and the ECB happens to move first, because they've been indicating that they could be ready to do so? What would the market impact be?
Yeah, Nastasia, that's an interesting one. I mean, Christine Lagarde has often been quoted in saying that we data dependent, we're not Fed dependent. But both of us know that's not the case. So it's sort of between a rock and a hard place. We know that the UK, which is not part of the ECB anymore, has gone into that technical recession following the Japan. And I think the ECB would like to evade that technical recession if they could. So as it currently stands, do I think they will jump the gun and actually start reducing rates before the Fed does? No, I don't think so. I think they will be Fed dependent, not data dependent. If they should do that, which I do think they should they do that, we could see the euro actually decline in value against the dollar, which could be very interesting because remember, currently they don't import a lot of the oil from Russia anymore. Russia is gone. We know Iran is also a bit of a problem. So they do import a lot of the oil currently from the US. And a decline in the euro would definitely increase the price of oil, which definitely be inflationary again. So, yeah, I think it's an interesting one. I mean, it does seem like we're going to be higher for longer.
What's the one tail risk that you're watching out for?
Oh boy, geopolitical. I think currently it's the main topic of conversation. We are, I mean, like I just said, I mean, we need interest rates to start retracing. I mean, yes, the US seem to be resilient, but I still question their strength currently. And it's like the Hemingway book said. I mean, they always said, "How did you go bankrupt?" It was slowly, and then ever so suddenly. Now, I say, how's the US going to go into recession? Well, I think it's going to be slowly, and then ever so suddenly. So, as we sit here, we know that there's basically no chance of seeing a rate cut in the US in May, no chance in June. Now, suddenly, we're only looking at about a 70% probability in September. Most likely only looking at November, September, so December. So I think that's going to be the most dangerous. Are we going to be forced to decline? But only time will tell.
All right, Skalk, let's leave it there. On our next conversation, we can talk about how the Fed moves in the lead up to elections and whether things could get a little bit political or not. But we'll save that conversation for another time. Skalk, thank you so much for your time. That is Skalk Low, who is a wealth manager at PSG. We're going to take a quick break. When we come back, we'll have SME on point, so stay tuned.